Two people put the same amount of money into the stock market on the same day in the same year. 30 years later, one of them has 4 times more than the other. They made no different choices after that first day. They bought the same things, they paid the same fees. The only difference was the day they checked their account. Tonight, we explain why that is possible and what it tells us about how markets actually work. Because the stock market is one of the most consequential institutions in the modern world, and also one of the most misunderstood. The version of the stock market that appears in daily news coverage is a number, a direction, an arrow pointing up or down, a reason to feel vaguely optimistic or vaguely anxious about the state of the economy. The version that appears in the minds of most people who invest in it is a system of bets, a casino of some kind, where some people win and others lose, and the outcome is governed by something between skill and luck. Neither of these versions is exactly wrong, but neither is complete enough to be genuinely useful. Tonight, we build the complete picture, from the first joint stock company in the 17th century through the crashes and booms and structural transformations that produced the stock market of today. And we connect that picture to the specific question of what it means for the money you have invested in it. But let us start somewhere closer, right here, in the world you live in. At this moment, let us begin with the most fundamental question. What is a stock? A stock, or share, is a unit of ownership in a company. When a company issues stock, it is dividing its ownership into equal units and selling those units to investors in exchange for capital. An investor who buys 1,000 shares of a company that has issued 1 million shares owns 1/10 of 1% of that company. She is entitled to 1/10 of 1% of whatever dividends the company pays, 1/10 of 1% of whatever assets remain if the company is liquidated, and 1/10 of 1% of the votes on matters that come before the shareholders. She is, in the most literal sense, a part owner of the business. This ownership stake is what gives stock its value, and it is worth being precise about what that value rests on. A share of stock is worth something because the underlying company has value. It generates revenue, it employs assets, it has relationships and intellectual property and market position that translate into earnings. The value of a share is, in principle, the present value of all the future cash flows that the company will generate and distribute to shareholders over its lifetime, discounted at an appropriate rate to reflect the time value of money and the uncertainty of those future cash flows. This is the theoretical foundation of stock valuation, and it is both genuinely correct and practically very difficult to apply, because it requires forecasting earnings far into an uncertain future and choosing a discount rate that itself reflects uncertain assessments of risk. The practical consequence of this theoretical difficulty is that stock prices are always, to some extent, expressions of opinion, collective assessments of an inherently uncertain future, rather than objective calculations of a known quantity. When a stock trades at a particular price, that price reflects the consensus view of the buyers and sellers in the market about the present value of the company's future earnings. And because the future is uncertain, and because reasonable people can have very different assessments of how a company will perform and what discount rate is appropriate for its risk profile, the price of any stock is always a matter of judgment rather than fact. This observation, that stock prices are inherently uncertain judgments about an uncertain future, is the starting point for understanding why the stock market behaves the way it does. Why prices can move dramatically on news that seems trivial. Why markets can be wildly optimistic in some periods and deeply pessimistic in others. Why even sophisticated investors with access to enormous amounts of information and computing power consistently struggle to outperform simple index funds over long periods. The uncertainty is not a defect of the market. It is the fundamental character of what the market is doing, aggregating millions of uncertain judgments about an unknowable future into a single number that represents the consensus view at this moment. There are several other concepts worth establishing clearly before we trace the history, because they will appear throughout what follows, and the distinction between them matters. The first distinction is between the primary market and the secondary market. The primary market is where companies issue new shares to raise capital. This is what happens in an initial public offering, when a company sells shares to investors for the first time, or in a follow-on offering, when an already public company issues additional shares. The secondary market is where existing shares are traded between investors after the initial issuance. This is what most people mean when they talk about the stock market, the daily buying and selling of shares on exchanges like the New York Stock Exchange or the NASDAQ. The primary market is where capital flows from investors to companies. The secondary market is where capital flows between investors, with the company whose shares are being traded receiving nothing from the transaction. Understanding this distinction is important because it clarifies a common misconception. When you buy shares of a company in the secondary market, you are not providing capital to that company. You are buying an ownership stake from another investor. The company itself is uninvolved in the transaction. The second concept is market capitalization, which is the total market value of all a company's outstanding shares, calculated by multiplying the current share price by the number of shares outstanding. Market capitalization is one of the most commonly used measures of a company's size in financial markets, and the classification of companies as large cap, mid cap, or small cap reflects their market capitalization relative to the rest of the market. The market capitalization of a company is not the same as its book value, which is the accounting value of its net assets, or its intrinsic value, which is the present value of its future cash flows. It is the market's collective assessment of what the company is worth at this moment, which may be more or less than either of those other measures. The third concept is the price-to-earnings ratio, or PE ratio, which is perhaps the most widely used single measure of whether a stock is cheap or expensive relative to its earnings. The PE ratio is calculated by dividing the stock's current price by its earnings per share, either the earnings of the past 12 months, which gives the trailing PE, or the expected earnings of the next 12 months, which gives the forward PE. A PE ratio of 20 means that investors are paying $20 for every dollar of annual earnings the company generates, which implies that at current earnings, it would take 20 years to recoup the purchase price from earnings alone. High PE ratios typically indicate that investors expect strong earnings growth in the future. Low PE ratios typically indicate either that investors expect weak growth or that the company is genuinely undervalued. The aggregate PE ratio of the stock market as a whole, which reflects the collective valuation of all the companies in the market, is one of the most closely watched indicators of whether the overall market is expensive or cheap relative to historical norms. The fourth concept is volatility, which measures how much a stock's price fluctuates over time. A stock with high volatility moves up and down dramatically in short periods. A stock with low volatility moves more steadily and predictably. Volatility is closely related to risk in financial theory, though the relationship is more complex than it is sometimes presented. A stock that is volatile, but whose long-run trajectory is strongly upward, may be less risky for a patient long-term investor than a stock that is stable, but whose business is slowly declining. The most widely watched measure of overall stock market volatility is the VIX, often called the Fear Index, which measures the market's expectation of volatility in the S&P 500 index over the next 30 days. based on the prices of options contracts on the index. A high VIX typically indicates that investors are nervous and expecting large price swings. A low VIX typically indicates relative calm and confidence. The fifth concept is the index, which is a statistical measure designed to track the performance of a group of stocks that represent some portion of the market. The most famous stock market indices are the Dow Jones Industrial Average, which tracks 30 large American companies, the S&P 500, which tracks 500 large American companies and is generally considered the most representative measure of the broad American stock market, and the NASDAQ Composite, which tracks all the stocks listed on the NASDAQ exchange and has a heavy concentration in technology companies. Indices serve several functions. They provide summary statistics about market performance that allow investors to assess how the market as a whole is doing. They serve as benchmarks against which the performance of individual stocks and investment managers can be measured. And they are the basis for index funds and exchange-traded funds, which allow investors to own a diversified portfolio of stocks that tracks a particular index with low cost and effort. But to understand why these concepts exist and why they matter, we need to trace the history of how the stock market developed, because the institutions and practices of modern equity markets are not natural or inevitable features of economic organization. They are historical achievements, the product of specific inventions and specific institutional decisions made across 4 centuries of financial history. The story begins in the early 17th century in Amsterdam at a moment of extraordinary commercial energy and institutional innovation. The Dutch Republic of the early 1600s was the most commercially sophisticated society in the world, a small country that had built a vast trading empire through a combination of navigational skill, financial innovation, and ruthless commercial calculation. The spice trade with Asia, which Dutch merchants had been developing since the late 16th century, offered spectacular profits but also required capital investments of a scale that exceeded what any individual merchant or partnership could comfortably provide. The ships were expensive, the voyages were long, the losses to weather and piracy and disease were substantial, and the capital would be tied up for years before a voyage returned and its profits could be distributed. The solution devised by the Dutch was the joint stock company, an entity that could raise capital from many investors simultaneously, pool that capital in a single enterprise, and distribute the profits proportionally when they were earned. The Dutch East India Company, or VOC, founded in 1602, was the most ambitious expression of this form. It raised an initial capital of 6.5 million guilders from investors across the Dutch Republic, far more than any previous commercial enterprise had mobilized, and it used that capital to build a trading empire that would persist for nearly 2 centuries and would at its height employ over 20,000 people and control a fleet of hundreds of ships. The shares in the VOC were initially intended to be redeemed after 10 years, but the company found the capital too useful to return, and the shares remained outstanding. Traded in the secondary market that developed spontaneously among Dutch investors who wanted either to sell their shares or to acquire more. The Amsterdam Exchange, where VOC shares were traded, established in 1611, was the first recognizable stock exchange in history. It provided a physical location where buyers and sellers of shares could meet, a set of rules governing transactions, and the price discovery mechanism that allowed shares to find their market value through the interaction of supply and demand. The trading that occurred on the Amsterdam Exchange already exhibited many of the features that characterize stock markets today. Rapid price fluctuations in response to news about the VOC's trading activities, the development of derivative instruments, including forward contracts and options that allowed investors to bet on future price movements without owning the underlying shares, The emergence of speculative activity alongside the more sober investment that the VOC's dividend-paying shares attracted, and the periodic episodes of irrational exuberance and panic that have characterized stock markets ever since. The English were not far behind the Dutch in developing equity markets. The East India Company, founded in 1600, was in some respects a precursor to the Dutch model, though it took longer to develop the liquid secondary market that the Amsterdam Exchange provided. London's financial center, concentrated in the coffee houses of the city, developed an active market in shares and financial instruments through the 17th century. And the South Sea Company, founded in 1711, was the occasion for the first great stock market bubble in English history. The South Sea Bubble deserves attention because it established patterns that would recur throughout the history of stock markets. The South Sea Company was granted a monopoly on British trade with South America, a concession that was in practice worth little because Spain controlled South America and had no intention of opening it to British commerce. But the company's promoters, with the connivance of government officials who were allowed to participate in the bubble for their own profit, launched a campaign of promotional hype that inflated the company's shares from around £100 in January 1720 to nearly £1,000 in June of that year. Investors across England, from dukes to domestics, poured their savings into the company, and the mania spread to dozens of related schemes, some of them transparently absurd. When the bubble burst in the autumn of 1720, the losses were catastrophic, wiping out the savings of thousands of investors and discrediting the joint stock form of organization so thoroughly that Parliament passed the Bubble Act, restricting the formation of joint stock companies without a specific act of Parliament, a law that persisted for over a century and significantly constrained the development of the British equity market. The Industrial Revolution, which unfolded in Britain from roughly the 1760s onward, created new demands for the equity market that eventually overcame the restrictions of the Bubble Act. The capital requirements of factories, railways, canals, and mines were enormous by the standards of earlier commercial enterprises, and the partnership form that had previously organized British business was inadequate to the scale of investment required. The railway mania of the 1840s, in which the prospect of a national railway network attracted speculative investment on a massive scale and produced a bubble and bust of the South Sea variety, was one of the episodes that eventually led Parliament to liberalize the company law, culminating in the Limited Liability Act of 1855, which allowed investors to participate in joint stock companies with the assurance that their personal liability was limited to the capital they had invested. The combination of limited liability, which reduced the risk of equity investment, and the Companies Act of 1856, which simplified the procedures for forming joint stock companies, created the institutional framework for the modern equity market in which investors could participate in commercial enterprises of any scale with limited risk and the expectation of proportional return. The development of the American stock market followed a somewhat different path, shaped by the specific political and financial institutions of the new republic. The New York Stock Exchange, founded in 1792 by a group of 24 brokers who signed the Buttonwood Agreement under a buttonwood tree on Wall Street, was initially a modest institution, trading primarily in government bonds and the shares of a small number of banks and insurance companies. It grew dramatically through the 19th century as the American economy expanded and the capital requirements of the railroad networks that were transforming the continent created demands for equity, financing on an unprecedented scale. By the late 19th century, Wall Street had become one of the great financial centers of the world, and the American equity market was the largest and most active in the Western Hemisphere. Let us bring together what we have traced so far, because this is the point where the history locks into something that makes the present legible. The stock market, as it exists today, is the product of 4 centuries of institutional evolution, driven by the recurring need to mobilize capital for enterprises whose scale exceeds what individuals or small partnerships can finance, and refined by the recurring experience of the bubbles and crashes and regulatory responses that each major episode of excess has produced. The joint stock company, the secondary market that allows shares to be traded, the stock exchange that provides price discovery and liquidity, the regulatory framework that governs disclosure and trading practices, and the index funds that allow ordinary investors to participate in the market's long-run returns with minimal cost and effort, are all solutions to problems that the history has repeatedly posed. Understanding the history gives you a framework for understanding why each of these elements exists and what it is designed to do. The most important thing the history tells us about the stock market is that it is both a mechanism for allocating capital to productive enterprises and a mechanism for speculation, and that these two functions coexist in permanent tension. The capital allocation function is the socially valuable one. By providing companies with access to equity financing, the stock market enables the investment in new products, new processes, and new enterprises that drives economic growth and generates the returns that investors receive. The speculative function is the one that produces the dramatic episodes of boom and bust that dominate the financial news. The periodic detachment of stock prices from any reasonable assessment of underlying value, driven by the self-reinforcing dynamics of collective enthusiasm and collective fear, produces the bubbles and crashes that have characterized stock markets since the Amsterdam Exchange first opened its doors. The relationship between these two functions is more intimate than it might appear. It is the speculative activity of traders seeking short-term profits that provides the liquidity that allows long-term investors to buy and sell shares efficiently. And that generates the price discovery that keeps prices in reasonable relationship to underlying value most of the time. Without the speculators, the market would be far less liquid and far more costly for the long-term investors whose capital allocation is the market's primary social function. But the speculative activity also periodically overwhelms the price discovery function and produces the disconnection between price and value that characterizes a bubble, with consequences that fall not just on the speculators who fueled the bubble, but on the broader economy that relies on the stock market for its capital allocation. The 20th century was the century in which stock markets grew from significant institutions serving a relatively narrow class of investors into the central mechanism of global capitalism, touching the financial lives of billions of people through pension funds, retirement accounts, mutual funds, and the broad ownership of equity that is developed in most advanced economies. The growth of institutional investing, the development of index funds, the democratization of access through discount brokers and later digital platforms, and the globalization of equity markets that has allowed investors in any country to own shares in companies anywhere in the world have all transformed the stock market from an institution that served primarily wealthy individuals and professional investors into one that mediates the retirement savings of the broad middle class. The transformation began in earnest in the post-Second World War period, when the combination of economic prosperity, the spread of employer-provided pension plans, and the gradual development of what would become the modern mutual fund industry began to channel the savings of ordinary workers into the stock market for the first time. The passage of the Employee Retirement Income Security Act in 1974, which established the regulatory framework for private pension plans, and the creation of the individual retirement account and the 401k plan in the late 1970s and early 1980s, which provided tax incentives for individual retirement saving, accelerated this process dramatically. By the 1990s, equity ownership in the United States had spread to a majority of households, and the stock market had become, for the first time in its history, something that touched the financial lives of most Americans rather than a minority. The index fund revolution, which began with John Bogle's founding of Vanguard and the introduction of the first index mutual fund in 1975, is perhaps the most consequential development in the history of retail investing. Bogle's insight was straightforward but radical in its implications. If most actively managed funds failed to outperform simple index strategies after fees and taxes, as the academic evidence consistently showed, then the rational choice for most investors was to accept the market's return rather than paying for active management that was unlikely to produce better results. The index fund delivered this return at minimal cost, and its adoption by investors who recognized the logic of Bogle's argument transformed the asset management industry over the following decades. By the early 21st century, index funds managed trillions of dollars and had captured a substantial fraction of the retail investment market, reshaping the competitive landscape of the asset management industry and producing ongoing debates about whether the growth of passive investing was itself distorting the price discovery function that gives markets their efficiency. The global financial crisis of 2008 was the most severe test of the stock market's resilience in the post-war period, and the pattern of its impact illustrated several of the most important features of how equity markets behave in a crisis. The S&P 500 index fell by more than 50% from its October 2007 peak to its March 2009 trough, a decline that wiped out years of retirement savings for millions of Americans and generated the kind of panic that leads investors to make the worst possible decision, selling at the bottom. The recovery from that trough, which was driven by the aggressive monetary and fiscal policy response to the crisis and by the underlying resilience of the American corporate sector, was equally dramatic. The S&P 500 reached new highs by 2013 and went on to deliver extraordinary returns over the following decade. The investors who held through the crisis, or who continued buying as prices fell, eventually recovered all their losses and far more. The investors who sold at the bottom locked in their losses and missed the recovery. This pattern of panic selling at the bottom, followed by recovery that rewards patience, has appeared in every major market downturn in history. The 1929 crash and the Great Depression, the 1987 crash, the dot-com bust, the 2008 crisis, and the sharp pandemic-driven decline of March 2020 all produced eventual recoveries that rewarded investors who did not sell. This does not mean that markets always recover quickly, or that every individual stock recovers after a decline, or that the pain of a major downturn is easy to tolerate while it is happening. It means that the long-run trajectory of the broad stock market has been upward because the companies that constitute it generate real earnings from real economic activity, and those earnings compound over time in a way that rewards patience over panic. The behavioral economics of investing deserves particular attention here, because the gap between what the stock market offers in principle and what most individual investors actually receive in practice is substantially explained by the psychological dynamics of investing, rather than by the mathematical properties of the market. Studies of investor behavior consistently show that individual investors, as a group, significantly underperform the indices that measure market returns. Not because the indices are doing something the investors cannot replicate, but because investors systematically buy after markets have risen and sell after they have fallen. Doing the opposite of what optimal investing requires, the emotional experience of watching a portfolio decline in value is sufficiently painful that many investors sell rather than holding or buying more. And the emotional experience of watching markets rise to new highs is sufficiently exciting that many investors buy at elevated valuations rather than maintaining disciplined allocation regardless of market levels. Understanding this dynamic does not make you immune to it. The loss aversion that drives panic selling and the herding behavior that drives buying at peaks are features of human psychology that knowledge alone does not overcome. But it does suggest where the most important decisions in investing are made, not in the choice between individual stocks, which is a domain where few individual investors have genuine advantage, but in the choice of how to structure your portfolio, how to maintain that structure through market volatility, and how to avoid the behavioral errors that consistently separate ordinary investors from the long-run returns the market offers. There is genuine and important debate among economists and investors about several aspects of how stock markets work, and being honest about that debate is part of giving an accurate picture of what the market is and what it offers. The most fundamental debate is about the efficient market hypothesis, the theory developed by Eugene Fama in the 1960s and 1970s that holds that stock prices already reflect all publicly available information about the companies they represent, making it impossible to consistently outperform the market through stock selection based on publicly available information. The strong form of this hypothesis, that markets reflect even private information, is generally considered too strong to be literally true. The weak and semi-strong forms, that prices already reflect past price history and publicly available information respectively, are supported by substantial evidence and have significant practical implications. They suggest that technical analysis, which uses past price patterns to predict future movements, and most forms of fundamental analysis, which use publicly available information about company finances to identify mispriced stocks, are unlikely to consistently generate superior returns after the costs of trading and research are accounted for. The evidence for the efficient market hypothesis, in its moderate forms, is strong but not conclusive. Decades of research have identified various market anomalies, patterns in stock returns that appear to persist over time and that cannot be easily explained by the efficient market framework. The value premium. The historical tendency for stocks with low price-to-book ratios to outperform stocks with high price-to-book ratios over long periods has been documented across many markets and time periods. The momentum effect, the tendency for stocks that have recently outperformed to continue outperforming in the short run, has similarly been documented extensively. And the size premium, the historical tendency for small company stocks to outperform large company stocks over long periods, has been one of the most replicated findings in academic finance. The debate about whether these anomalies represent genuine inefficiencies that patient investors can exploit, or whether they are simply compensations for risk that the standard models have not fully captured, is ongoing and genuinely unresolved. What is clear is that even if the anomalies are real and exploitable, exploiting them in practice requires discipline, patience, and tolerance for extended periods of underperformance that most investors find difficult to maintain. The gap between the theoretical return of a strategy and the actual return achieved by an investor implementing that strategy is substantial, and it is explained in large part by the behavioral dynamics we discussed earlier. There is also an important debate about the relationship between the stock market and the real economy, specifically about whether stock market performance is a reliable indicator of economic health or a misleading proxy that can diverge significantly from what is happening to the broader population. The dissatisfaction with using stock market performance as a measure of economic well-being has grown as the distribution of stock ownership has become more clearly understood. If the wealthiest 10% of households own 80% of equities, as recent data suggests for the United States, then a rising stock market primarily benefits the wealthy, and a falling stock market primarily harms the wealthy, with much more muted effects on the financial lives of the majority. The stock market is a measure of what investors think publicly traded companies are worth, not a measure of how well ordinary people are doing economically. And conflating the two produces a systematically distorted picture of economic reality. What this means for you, specifically and practically, begins with the most basic understanding that the stock market is not primarily a gambling mechanism or a speculative arena. Though speculation happens within it, it is, at its core, a mechanism for buying a share of the future earnings of productive enterprises, and the long-run return it offers reflects the long-run growth of those earnings, which in turn reflects the long-run growth of the real economy and the productivity improvements that make it possible to produce more with less over time. This means that investing in a diversified portfolio of equities held patiently over a long period is one of the most powerful wealth-building tools available to ordinary investors. Not because the market is always rising or because every investment works out well, but because the long-run tendency of the earnings of productive enterprises is upward. And the investor who participates in that tendency through a low-cost index fund without trying to time the market or pick winning stocks is doing something mathematically sensible rather than merely hoping. The evidence that this approach, low-cost, diversified, patient, is the right one for most investors is now about as strong as the evidence gets in the social sciences. Accumulated across decades of research in multiple countries and multiple market environments. It also means that the decisions that matter most in investing are not the exciting ones, not the individual stock picks, or the market timing calls, or the portfolio tweaks that dominate the conversation about investing in popular media. They are the boring ones. Deciding how much to save, deciding on an appropriate allocation between equities and other asset classes based on your time horizon and risk tolerance, choosing low-cost vehicles to implement that allocation, and then largely ignoring the daily movements of the market and the constant stream of commentary encouraging you to do something different. The investors who get rich slowly by doing these boring things consistently outperform over their investing lifetimes the investors who pursue the exciting things that the financial media covers. Understanding the history of the stock market is part of being equipped to do the boring things consistently. The history provides context for market volatility that makes it easier to tolerate. Knowing that markets have recovered from every previous crisis, including ones that looked more catastrophic than anything you are likely to experience, makes it easier to hold through a downturn without selling. The history provides perspective on the long-run trajectory of the market that makes short-term fluctuations seem less consequential. Knowing that the market was 100 times higher in 2020 than in 1950 makes a 20% decline in a single year feel less permanent than it might otherwise seem. And the history provides caution about the moments of maximum enthusiasm, when valuations are stretched and everyone seems to be getting rich. Knowing that those are the moments most likely to precede disappointment makes it easier to maintain discipline when the crowd is most excited. There is a quiet human thread running through the entire history of the stock market, worth pulling into the light before we rest. The stock market is, at its deepest level, a mechanism for cooperation under uncertainty, a way for people who have capital to deploy it in the service of people who have productive ideas and the capacity to implement them at a scale and a degree of risk diversification that neither could achieve alone. The investor who bought shares in the Dutch East India Company in 1602 was taking a specific risk for a specific return on a specific venture. The investor who buys an S&P 500 index fund today is taking a more diffuse risk for a more diffuse return on the collective productive activity of 500 of the most significant companies. In the American economy, the specific instruments have changed beyond recognition. The underlying logic of the exchange between those with capital and those with productive capacity has not. The market has failed, sometimes spectacularly, to perform its capital allocation function in periods when speculation overwhelmed the pricing mechanism and capital flowed to enterprises that had no path to genuine profitability. The dot-com bubble of the late 1990s allocated enormous sums to internet companies that generated no earnings and had no coherent plan for generating any. The subprime mortgage boom of the 2000s allocated capital to a financial infrastructure that was systematically underestimating risk and mispricing it in ways that eventually produced catastrophic losses. These failures are real and consequential, and they are part of the honest picture of what the stock market is. But so is the longer history of the market's success in channeling capital to genuinely productive enterprises, to the railroads that connected the American continent, to the industrial companies that built the manufacturing capacity of the 20th century, to the technology companies that have transformed how humans communicate and access information, and to the countless smaller and less famous enterprises that have generated employment and economic value for the communities in which they operate. The stock market has funded a significant portion of the economic growth of the past 4 centuries, and the long-run returns it has provided to patient investors reflect the genuine value that growth has created. You are lying there now, in the quiet. Some portion of your money is in the market, whether you have chosen to put it there or whether it has been placed there on your behalf through a pension or a retirement account. A number that represents your claim on a fraction of the earnings of productive enterprises is resting in a database somewhere, moving slightly as after-hours trading occurs in markets around the world, settling toward whatever value the next trading day will produce. The number will be different tomorrow from what it is tonight, for reasons that reflect everything from the earnings reports of specific companies to the policy decisions of central banks to the sentiment of investors trying to anticipate what other investors will do. The history of how that number came to exist and why it matters, and what the long arc of its movement tells us about the relationship between patience and return, between speculation and value, between the short-term noise and the long-term signal, is what we have traced tonight. You carry it now, resting here as a framework for understanding something that will continue to shape your financial life for as long as you live within the modern economy. And here, in the quiet, the market rests, as it always does, between sessions, waiting for the next morning's opening bell to bring another day of collective judgment about an uncertain future. And that, perhaps, is exactly the right place to rest. There is a dimension of the stock market's history that we have touched on but not fully developed, and it is the one that connects most directly to how ordinary people experience the market in their daily lives. The history of financial crises originating in or transmitted through the equity markets, and the specific patterns that those crises have followed across 4 centuries of market history. The first pattern, and the most consistent, is what the economist Hyman Minsky described as the credit cycle applied to asset markets. A period of stability generates optimism. Optimism generates risk-taking. Risk-taking generates rising prices. Rising prices validate the optimism and generate more of it. And the cycle continues until some event or threshold is reached that reverses the direction. The trigger for the reversal can be almost anything: a rise in interest rates, a disappointing earnings report, a geopolitical event, or simply the exhaustion of the supply of new buyers willing to pay ever higher prices. What matters is not the specific trigger, but the dynamics that make any trigger sufficient. When prices have risen far enough that they require a constant supply of optimistic buyers to sustain them, the absence of that supply is sufficient to start a decline, and the decline itself generates the pessimism that accelerates it. The South Sea Bubble of 1720, the first great stock market crisis in English history, followed this pattern with remarkable clarity. The initial rise in South Sea Company shares was supported by genuine, if exaggerated, optimism about the profitability of the trade concessions the company held. The rise attracted buyers who were motivated not by any assessment of the company's actual prospects, but by the belief that prices would continue to rise and that they could sell to a greater fool at a higher price. The promoters of the scheme encouraged this speculation by offering shares on credit terms that required only a small initial payment, allowing investors to acquire large positions with small capital and to profit handsomely if prices continued to rise. When prices stopped rising and investors attempted to liquidate their positions, the credit mechanism ran in reverse. Investors who had borrowed to buy shares were forced to sell when prices fell, driving prices lower, forcing more selling in a cascade of margin calls that produced the precipitous decline from which the bubble did not recover. This specific mechanism, the forced selling of leveraged positions as prices fall, is a recurrent feature of market crashes throughout history. And understanding it helps explain why crashes can be so much faster and more severe than the bubbles that precede them. During the bubble, optimism is self-reinforcing because rising prices generate more buyers. But there is some natural limit to how fast prices can rise because new buyers need time to find and deploy capital. During the crash, pessimism can be self-reinforcing in a much more acute way because forced sellers, those who have borrowed to buy and are forced to sell as prices fall below the level their margin requirements allow, can generate enormous selling pressure very quickly, driving prices down in a matter of days or hours rather than months. The 1929 crash and the subsequent Great Depression was the most devastating equity market crisis in modern history, and its causes and consequences have been studied exhaustively by economists and historians seeking to understand both what produced it and what prevented its recurrence in subsequent downturns. The bubble of the late 1920s was fueled by easy credit, the expansion of margin lending that allowed investors to buy stocks with as little as 10% of their own capital, and by the speculative enthusiasm that a decade of prosperity and rising prices had generated. When the crash began in October 1929, the forced selling of margined positions produced one of the fastest and most severe price declines ever recorded, with the Dow Jones Industrial Average falling nearly 50% in the 2 months following the peak. But the Great Depression was not simply the consequence of the 1929 crash. The crash was severe, and it was the occasion for the Depression. But the Depression itself was the product of the policy failures that followed it. The failure of the Federal Reserve to prevent the contraction of the money supply as banks failed. The passage of the Smoot-Hawley tariff that provoked retaliatory trade restrictions and devastated international trade, and the deflationary fiscal policies of the Hoover administration that amplified rather than cushioned the economic downturn. The lesson that economic historians have drawn from the Depression, that the policy response to a financial crisis matters at least as much as the crisis itself, shaped the response to every subsequent market crisis. From the 1987 crash through the 2008 financial crisis and the pandemic-driven decline of 2020. The crash of 1987, sometimes called Black Monday, was, in terms of its single-day magnitude, the most severe stock market decline in American history. The Dow Jones Industrial Average fell by 22.5% on October 19, 1987, a decline that dwarfed anything that had occurred even in the worst days of 1929. And yet, the Depression did not follow. The Federal Reserve, under Alan Greenspan, responded immediately by signaling its willingness to provide liquidity to the financial system, preventing the banking crisis that had amplified the Depression from occurring. The economy slowed briefly but did not collapse, and the stock market recovered within 2 years. The contrast between the Depression and the aftermath of 1987 is a stark illustration of the importance of the institutional response to financial crises that the Depression's lessons had taught. The dot-com bubble of the late 1990s and its subsequent collapse from 2000 to 2002 was different in character from the crashes of 1929 and 1987. Because the speculative excess was concentrated primarily in a specific sector rather than in the market as a whole, and because the bubble was driven more by genuine enthusiasm about a transformative technology than by pure financial speculation disconnected from any underlying economic development. The Internet was real, and the companies that would eventually dominate it, Amazon and Google among them, were genuinely transformative enterprises that would prove to be worth more than their peak bubble valuations. But the bubble also included hundreds of companies that had no coherent path to profitability and that attracted capital because of the general enthusiasm about the sector, rather than any specific assessment of their prospects. When the bubble burst, the Nasdaq fell by nearly 80% over 2 years, and many of the most enthusiastically valued companies of the bubble period went to zero. But the broader economy did not enter a severe recession. The dot-com bust was painful for those who had concentrated their investments in technology stocks, but its effects on the financial system were relatively contained, and the economic slowdown that followed was mild by historical standards. The lesson some drew from this experience was that the stock market could crash without taking the broader economy with it. As long as the financial system was not excessively leveraged to the declining asset class, that lesson would be dramatically overturned by the financial crisis of 2008, which demonstrated what happens when the declining asset class is mortgages, which are the primary form of collateral supporting the entire banking system. The stock market crash that accompanied the 2008 financial crisis, which we have discussed in some detail in earlier conversations, was distinct from the dot-com crash in its transmission to the real economy. The decline of over 50% in the S&P 500 was itself severe, but its economic consequences were amplified by the banking crisis that ran alongside it, which contracted credit throughout the economy and produced the sharpest economic downturn since the Depression. The stock market recovery began in March 2009, before the economy had fully stabilized, driven by the extraordinary policy response of the Federal Reserve and the fiscal stimulus of the Obama administration. But the economic recovery was slow, and the communities most severely damaged by the crisis, those dependent on manufacturing and construction, and the working-class jobs that the financial sector's excesses had displaced, did not participate fully in the stock market boom that followed. The pandemic-driven decline of March 2020 was the fastest bear market in history, with the S&P 500 falling 34% in 33 days as the economic consequences of the global shutdown became apparent. And it was followed by one of the fastest recoveries in history as the Federal Reserve deployed its full arsenal of monetary support, and Congress passed the largest fiscal stimulus in American history. The market reached new highs by August 2020, less than 6 months after the crash, and went on to deliver extraordinary returns through 2021. The recovery was powered in part by the same dynamics that had driven the post-2008 recovery. Low interest rates, making equities attractive relative to alternatives, government support preventing the worst economic outcomes, and the underlying resilience of corporate earnings in a digital economy that could function more effectively than the physical economy through a period of social distancing. The pattern that emerges from these episodes is not a simple one. Markets crash for different reasons, in different ways, with different economic consequences, and the appropriate response to a crash depends on its causes and its transmission mechanisms. But several features are consistent. Crashes are followed by recoveries in every case in the history of the broad market, though the timing and path of those recoveries varies enormously. The policy response matters enormously. The Depression showed what happens when policy fails to respond adequately, and the experience since 1987 has shown what happens when it responds decisively. And the investors who hold through crashes rather than selling consistently do better than those who sell, because the recovery eventually delivers returns that reward the patients who stayed in, while punishing those who locked in their losses at the bottom. There is something that the history of stock market crashes teaches that goes beyond the financial. They are, in every case, episodes in which collective psychology overrides individual rational calculation in ways that the rational model of investor behavior would not predict. The panic selling of a crash is not primarily the behavior of rational actors updating their probability assessments of future cash flows in light of new information. It is primarily the behavior of frightened people responding to falling prices and rising uncertainty with the same instinct that evolution has equipped humans with for responding to perceived threats: the instinct to flee. Understanding this does not make it easy to resist the instinct when the moment comes, but it does give you a framework for recognizing what is happening and for having established in advance the structures and commitments that can protect you from acting on it in ways you will regret. The practical implications of this understanding connect to the behavioral economics we explored on an earlier evening, and they are simple to state even if they are difficult to implement. The most important single decision a stock market investor makes is not which stocks to buy or when to buy them. It is whether to hold through the inevitable declines that the market produces or to sell when the emotional pressure to do so becomes intense. The investors who hold and who maintain or increase their contributions during downturns rather than reducing them consistently accumulate far more wealth over their investing lifetimes than those who sell at the bottom and buy back in at higher prices. This is not a deep insight. It is a straightforward consequence of the mathematics of compounding applied to an asset class whose long-run trajectory is upward. But it is an insight that a substantial fraction of investors fail to act on, because the emotional experience of holding through a decline is painful enough that the rational calculation loses to the emotional response. The development of automatic investment programs, target date retirement funds, and other mechanisms that make continued investment the default rather than the active choice is one of the most important institutional responses to this behavioral problem by removing the need to make an active decision to continue investing during a market decline. These mechanisms exploit the same behavioral dynamics that produce panic selling when people are left to make active choices. The tendency to stick with whatever the current arrangement is, the preference for inertia over action, the difficulty of doing something that requires overcoming fear. Instead of asking people to summon the courage to buy when prices are falling, these mechanisms make continued buying the automatic default that requires no active decision. There is something worth saying about the role of the stock market in the broader project of economic inequality and the distribution of wealth, because this context matters for understanding what the stock market is and what it does to the society within which it operates. The long-run positive returns of the stock market are, in principle, available to anyone who invests. In practice, the distribution of equity ownership is highly concentrated among the wealthy, and the benefits of stock market returns flow disproportionately to those who have the most to invest. This is not a design flaw, of the stock market specifically. It is a consequence of the broader distribution of wealth in society, which determines who has capital available to invest, and therefore who benefits most from the returns that investment generates. The stock market amplifies existing wealth inequality rather than creating it, but the amplification is substantial, and its consequences are significant for how we understand the relationship between financial market performance and broader economic well-being. The expansion of retirement account ownership that has occurred in the United States over the past 4 decades has partially democratized access to stock market returns, giving middle-class workers who participate in 401k plans and IRAs a meaningful stake in equity market performance. But participation rates in retirement accounts remain significantly lower among lower-income workers, and the accounts of those who do participate tend to be smaller and to be invested more conservatively, reducing their exposure to the equity returns that have driven the long-run wealth building of more affluent investors. The financial advice industry's consistent recommendation to maximize contributions to tax-advantaged retirement accounts and to invest those contributions in diversified equity portfolios is correct and important, but acting on it requires a level of financial surplus and financial literacy that is not equally distributed across the population. Understanding these limitations of stock market access and their consequences for wealth distribution is part of having an honest picture of what the stock market is and what it does. It is a powerful tool for wealth building, and the evidence for the superiority of patient, diversified equity investing over the alternatives is about as strong as the evidence gets in personal finance. But it is a tool whose benefits are distributed unequally. And understanding that unequal distribution is part of understanding the relationship between financial markets and the broader social and economic context within which they operate. You carry all of this now, resting here in the quiet. The stock market, in its full complexity, as a mechanism for capital allocation and speculation and wealth building and wealth inequality. As an institution, with a 400-year history of booms and busts, and institutional innovations and regulatory responses, as the vehicle through which some portion of your own savings is connected to the productive capacity of the modern economy. The number that represents your stake in that economy will move again tomorrow, for reasons that you cannot fully predict and that no one else can fully predict either. And over the years and decades ahead, the cumulative movement of that number will tell the long story of your participation in the world's most consequential cooperative institution. The bell will ring tomorrow morning. The market will open. The collective judgment of millions of investors will resume its continuous work of pricing the uncertain future. And here, in the dark, none of that requires your attention. What you carry is enough. The rest can wait until morning. But there is a dimension of the stock market that most introductions to the subject skip over. And it is the one that connects most directly to the question of how stock prices are actually determined in practice, as opposed to in theory. The theory says prices reflect the present value of future cash flows. The practice is considerably more complex, more human, and more interesting than the theory suggests. The stock market operates through a continuous auction in which buyers and sellers submit orders, and the market price is determined by the intersection of supply and demand at any given moment. In the modern market, this auction is conducted electronically at extraordinary speed. The New York Stock Exchange and NASDAQ process millions of trades, and high-frequency trading firms can submit and cancel orders in microseconds, taking advantage of tiny price discrepancies across different trading venues. The market you see when you check a stock price on your phone is the aggregate output of this continuous, high-speed auction, processed and displayed in a form that makes it legible to ordinary investors, even though the underlying mechanism is operating at a pace and a level of complexity that no human can fully observe in real time. The participants in this auction range from individual investors placing orders through retail brokerage accounts to institutional investors managing billions of dollars for pension funds and endowments, to algorithmic trading systems executing strategies developed by quantitative analysts with advanced degrees in mathematics and physics. These participants have vastly different information, different time horizons, different objectives, and different methods for assessing what a stock is worth. The price, at any moment, is the result of their collective interaction, a point of temporary equilibrium between the buyers who think the stock is undervalued at the current price and the sellers who think it is fairly valued or overvalued. The information that feeds into this collective assessment is enormous in volume and varied in quality. Quarterly earnings reports, which public companies are required to file with securities regulators, provide detailed information about revenues, expenses, profits, and 100 other financial metrics that analysts use to assess a company's current performance and future prospects. Analyst research reports, produced by the research departments of investment banks and independent research firms, provide assessments of individual companies and industries that institutional investors use to inform their trading decisions. Management guidance, the forward-looking statements that company executives make about their expectations for future performance, is closely parsed for signals about whether results are likely to meet, beat, or miss the consensus expectations of analysts. And the entire ecosystem of economic data, from GDP reports to employment statistics to inflation readings to central bank decisions, provides the macroeconomic context within which individual company assessments are made. In addition to this public information, market participants form their assessments based on softer signals: the quality and credibility of management teams, the competitive dynamics of the industries in which companies operate, the technological trajectories that are likely to affect demand for specific products or services, the regulatory environment and how it is likely to evolve, and the countless judgments about positioning and strategy that separate companies that will create value over the long run from those that will not. These softer assessments are more difficult to systematize and more susceptible to bias and error than the quantitative analysis of financial statements, but they are also, in many cases, more consequential for long-run investment outcomes. The role of expectations in determining stock prices is one of the most important and most consistently underappreciated features of how markets work. A stock's price reflects not what the company has done, but what investors expect it to do. And the change in price from one moment to the next reflects not the absolute level of performance, but the change in expectations about future performance. A company that reports strong earnings growth but falls short of what analysts had expected will typically see its stock fall on the announcement, even though its earnings are growing strongly. A company that reports weak results but less weak than feared will typically see its stock rise, even though its performance is poor in absolute terms. The market is always pricing expectations, not reality. And understanding this helps explain many of the counterintuitive movements that confuse investors who are thinking about fundamental value rather than about the relationship between reality and prior. Expectations. This expectations-based nature of stock pricing also explains the phenomenon of momentum, the tendency for stocks that have recently risen to continue rising and stocks that have recently fallen to continue falling. If a stock's price rises because of improving expectations, and those improving expectations are reflected in better actual performance that generates further improvement in expectations, then the price continues to rise in a positive feedback loop. Conversely, If a stock's price falls because of deteriorating expectations, and those deteriorating expectations are reflected in worse actual performance, that generates further deterioration in expectations. The price continues to fall. The momentum effect is not pure speculation disconnected from fundamentals. It often reflects a gradual process of expectations adjustment in which investors and analysts are slow to fully revise their assessments in response to new information, so that the initial price move is followed by further moves in the same direction as the information is more fully incorporated. The way that professional investors use information to form assessments of stock value has changed dramatically over the course of the market's history, and the changes have significant implications for ordinary investors trying to understand what the market is doing and why. In the early history of the equity markets, before systematic financial reporting was required, investors had very limited information about the companies they were considering, and the market was correspondingly more susceptible to manipulation and fraud. The practice of watering stock, issuing shares in excess of the genuine capital of the company, was widespread in the 19th century, and the promoters of railway and mining companies routinely made representations about their prospects that bore little relationship to the reality. The development of securities regulation, which accelerated dramatically in the United States after the stock market crash of 1929, and the subsequent congressional investigations revealed the extent of the fraud and manipulation that had characterized the bull market of the 1920s, was a response to these abuses. The Securities Act of 1933 and the Securities Exchange Act of 1934, which required companies to provide detailed financial disclosures and prohibited various forms of market manipulation, fundamentally changed the information environment of the American stock market. The development of fundamental analysis, the systematic assessment of company financials to identify undervalued stocks, is usually dated to the publication of Security Analysis by Benjamin Graham and David Dodd in 1934, a book that has served as the intellectual foundation of value investing for 90 years. Graham and Dodd's central insight was that the prices at which stocks traded were often far removed from their intrinsic value, the present value of the earnings and assets they represented, and that a disciplined investor who bought stocks when they were significantly below their intrinsic value, with a sufficient margin of safety to allow for errors in the valuation, could generate superior returns over time. Graham's most famous student, Warren Buffett, has applied this philosophy with extraordinary success over a career spanning more than 6 decades, accumulating one of the largest fortunes in the world through the patient identification and purchase of undervalued businesses. The rise of quantitative analysis, using statistical models and large data sets to identify patterns in stock returns that can be exploited systematically, has supplemented and, in some respects, supplanted fundamental analysis as the dominant approach in institutional investing over the past 3 decades. The quantitative revolution in investing, driven by the availability of large financial data sets and the computing power to analyze them, has produced a range of systematic investment strategies, from the simple value and momentum factors identified in academic research to the highly sophisticated machine learning models of the most advanced quantitative hedge funds. The debate between fundamental and quantitative approaches to investing remains active and is unlikely to be resolved definitively, because both approaches have produced periods of strong performance and periods of failure, and the specific market environment matters significantly for which approach works better at any given time. For ordinary investors, the practical implication of this evolving landscape of professional investment is straightforward and has been consistent for decades. The competition in the professional investment management industry is so intense, and the information advantages of the most sophisticated participants are so significant, that it is extremely difficult for individual investors or even most professional managers to consistently outperform simple index strategies after costs. The average actively managed fund underperforms its benchmark index after fees, and the minority that outperforms in any given period does not, on average, continue to outperform in subsequent periods. This does not mean that active management is worthless, or that every individual security selection decision is made on equal footing with every other. It means that for the ordinary investor, whose resources and expertise do not match those of the most sophisticated market participants, accepting the market's return through low-cost index funds is likely to produce better outcomes over time than attempting to generate above-market returns through stock selection or market timing. The growth of index investing that this insight has generated, from John Bogle's first index fund in 1975 to the trillions of dollars in index funds and exchange-traded funds today, has itself raised new questions about how markets function. When a large and growing fraction of equity assets are managed passively, tracking indices, rather than making individual stock selections based on fundamental assessment, does the price discovery function of the market deteriorate? If fewer analysts are doing the fundamental work of assessing whether individual stocks are fairly valued, do mispricings persist longer and become more severe? These questions are the subject of active academic and policy debate, and the answers are not yet clear. What is clear is that the growth of passive investing has reduced the costs of equity investment dramatically for ordinary investors, and that this cost reduction has been one of the most significant improvements in financial services for individual investors in the past 50 years. There is also an important dimension of the stock market's recent history that deserves attention: the transformation of market structure driven by technology, particularly the rise of electronic trading, high-frequency trading, and the proliferation of trading venues that has characterized the market since the 1990s. The transition from floor-based trading, in which human specialists and market makers manage the flow of orders on physical exchange floors, to electronic trading, in which algorithms process orders in microseconds, has reduced trading cost significantly, narrowed bid-ask spreads, and increased the speed and efficiency of price discovery. But it has also created new risks and new forms of market dysfunction, illustrated most vividly by the flash crash of May 6, 2010, in which the Dow Jones Industrial Average fell by nearly 1,000 points in a matter of minutes before recovering most of the loss within hours, driven by a cascading interaction between algorithmic trading systems that the humans overseeing them could not fully understand or control in real time. The flash crash raised important questions about the resilience of modern market structure and the adequacy of the regulatory framework governing it, questions that have continued to be debated and that have generated a series of regulatory responses aimed at reducing the risk of similar episodes. The proliferation of trading venues, exchanges, and alternative trading systems that characterizes the modern equity market has improved competition and reduced costs, but has also created a fragmented market structure that can behave in unexpected ways when the interactions between different systems produce cascading feedback loops that no individual participant intended or anticipated. Understanding the structural features of the modern market is not strictly necessary for making sound, long-term investment decisions, which are more about allocation, diversification, cost minimization, and behavioral discipline than about the microsecond dynamics of electronic trading. But they are part of the complete picture of what the stock market is today, and they help explain some of the phenomena that individual investors encounter and find puzzling. The sudden, sharp price movements that occur without obvious news, the occasional trading halts that regulators impose when prices move too fast, and the generally higher volatility that electronic markets can produce in comparison to the floor-based markets they replaced. There is something the orientation paragraph of this conversation wants to be clear about before we move toward the end. And it concerns the specific question of what all of this history and theory actually means for the decisions you will face in the years ahead, not in abstract, but in the moments that matter. The month the market drops 20% and every instinct says to sell, the quarter when a particular sector is generating extraordinary headlines and everyone around you seems to be getting rich from it. The year when your portfolio feels small and the returns feel inadequate and the temptation to do something different is strong. The stock market is not a casino, though it can behave like one in the short run. It is not a machine for making everyone rich, though patient participants in diversified equity portfolios have historically done very well over long periods. It is not fully efficient in the sense that every price perfectly reflects all available information at all times, though it is efficient enough that most attempts to outperform it consistently fail after costs. And it is not disconnected from the real economy, though the relationship between stock prices and economic conditions is complex enough that they can diverge significantly in the short run. What it is the most consequential mechanism in the modern capitalist world for translating the productive capacity of enterprises into financial claims that can be owned, traded, and valued by millions of investors. The price it puts on that productive capacity is imperfect and volatile in the short run, reflecting the full range of human psychology, including fear and greed and herding and overconfidence. But over long periods and in aggregate, it does what markets are supposed to do. It allocates capital toward productive uses. It disciplines poorly managed enterprises through the threat of declining valuations, and it delivers to patient, diversified investors a share of the economic growth that the enterprises it finances generate. You are lying there now, in the quiet. The market closed some hours ago, and the computers that run it are idle in their data centers, waiting for tomorrow's opening. The number that represents your stake in the productive capacity of the modern economy is resting, unchanged, until the market reopens. A point of temporary equilibrium between all the assessments and expectations and hopes and fears that will animate tomorrow's trading. The history that produced that number, from the Dutch East India Company's first share offering in 1602 through 4 centuries of crashes and recoveries and institutional innovations and regulatory reforms, is now part of what you carry. And the understanding of what the number means, not a verdict on the present state of the economy, not a measure of your own financial health from day to day, but a long-run claim on the productive capacity of enterprises whose earnings have compounded steadily upward across every crisis and recovery in the history of the modern economy, is a framework that will serve you well across all the volatility that lies between now and the retirement or the legacy that your investment is building toward. The bell will ring in the morning, and here, resting in the dark, you are ready for whatever it brings. There is one more chapter of the stock market's history that deserves careful attention, because it represents the period in which the market moved from a mechanism serving a relatively narrow class of wealthy investors to a mechanism that touches the financial lives of the majority of people in developed economies. This is the story of the democratization of equity investing, and it is a story with both a triumphant dimension and a complicated one. The pension revolution of the post-war period was the first great wave of equity democratization, as employers in the United States and other developed countries established defined benefit pension plans that promised workers a specific retirement income based on their years of service and final salary. They needed to invest the assets accumulated in those plans in assets that would generate sufficient returns to meet those promises, the actuarial mathematics of pension funding, which required earning a return sufficient to meet obligations that might extend decades into the future, pointed strongly toward equities, which had historically delivered the highest long-run returns of any major asset class. Over the course of the 1950s and 1960s, institutional investors managing pension assets became the dominant force in the equity markets, displacing the wealthy individual investors and speculative traders who had previously dominated trading volume. This shift in the composition of market participants had significant consequences for market behavior. Institutional investors, managing money on behalf of beneficiaries rather than their own capital, were more accountable for their investment decisions and more focused on long-term returns than individual speculators. They were also more interested in the research and analysis that could inform better stock selection, driving the development of the sell-side research industry, in which investment banks employed analysts to produce detailed assessments of individual companies and industries that institutional investors could use to make better informed decisions. The professionalization of investing, driven by the growth of institutional ownership, changed the character of the market in ways that made it, on balance, more analytical and somewhat less purely speculative than it had been in the pre-war era. The second great wave of equity democratization came with the shift from defined benefit to defined contribution retirement plans, which began in the late 1970s and accelerated through the 1980s and 1990s. Under defined benefit plans, employers bore the investment risk. If the pension assets underperformed, the employer was responsible for making up the shortfall and meeting the promised benefits. Under defined contribution plans, employees accumulate retirement savings in individual accounts and bear the investment risk themselves. The amount available in retirement depends on how much was contributed and how the investments performed, with no employer guarantee of a specific benefit level. The 401k plan, which became the dominant form of defined contribution retirement saving in the United States following the Revenue Act of 1978, placed individual workers in charge of their own investment decisions for the first time, with enormous consequences for both the equity markets and the financial outcomes of millions of Americans. The consequences for the equity markets were largely positive in aggregate. The flow of regular contributions from millions of defined contribution accounts created a steady source of demand for equities that contributed to the strong market performance of the 1980s and 1990s and helped dampen the volatility that might otherwise have accompanied major market events. The consequences for individual investors were more mixed. Workers who made good investment decisions, who invested consistently regardless of market conditions, diversified their holdings, kept costs low, and maintained their allocations through market downturns, generally accumulated substantial retirement savings through the defined contribution system. Workers who made poor investment decisions, who invested too conservatively out of risk aversion, who sold during downturns, who concentrated their holdings in their employer's stock, or who failed to contribute consistently, often accumulated far less than they would have received under a comparable defined benefit plan. The transition from defined benefit to defined contribution retirement saving was, in effect, a transfer of investment risk from large, professionally managed institutional investors to individual workers who lacked the expertise, the time, and in many cases the financial cushion to bear that risk comfortably. The financial consequences of poor investment decisions, which in a defined benefit system would be borne by the employer, are in a defined contribution system borne by the worker, often in the form of inadequate retirement savings that are not discovered until the worker is too close to retirement to remedy them. The inadequacy of retirement savings among Americans approaching retirement age is one of the defining financial challenges of the early 21st century, and it is substantially a consequence of the transition to defined contribution saving and the behavioral and investment challenges that individual workers have consistently struggled with in managing their own accounts. The mutual fund industry's response to the defined contribution revolution was to develop the product that made equity investing accessible and understandable to ordinary workers. The diversified stock mutual fund, which pools the capital of many investors, provides professional management and allows each investor to own a diversified portfolio with a relatively small investment. By the early 1990s, mutual funds had become the dominant vehicle through which ordinary Americans participated in the equity market, and the growth of mutual fund assets from a few $100 billion in the mid-1980s to several $1 trillion by the turn of the century reflected the enormous scale of the defined contribution retirement saving that was flowing into the market. John Bogle's contribution, the index fund, should be understood in this context as a specific response to the specific failure of the mutual fund industry to deliver on its promise to individual investors. The mutual fund industry sold itself on the promise of superior returns through professional management, but the evidence was clear, even by the late 1970s, that most actively managed funds failed to outperform their benchmark indices after fees, and that the failure was systematic rather than the result of bad luck in specific periods. Bogle's index fund offered individual investors a way to own the market's returns without paying for active management that, on average, did not earn its fees. The original Vanguard Index Fund was mocked by competitors as Bogle's folly, derided as a strategy that guaranteed mediocrity. It turned out to guarantee something closer to the best returns that most investors could realistically achieve, and its success over the following decades transformed the fund industry and generated trillions of dollars in cost savings for ordinary investors. The development of exchange-traded funds, or ETFs, in the 1990s and their explosive growth in the 2000s and 2010s extended the index investing revolution to a broader range of asset classes and investor types. An ETF is an index fund that trades on a stock exchange like an individual stock, allowing investors to buy and sell throughout the trading day at market prices rather than at the end-of-day price at which mutual fund shares are transacted. ETFs initially tracked broad market indices like the S&P 500, but the format has since been applied to narrow sectors, international markets, specific factor exposures, fixed income, commodities, and many other asset classes, giving investors unprecedented flexibility to construct diversified portfolios at very low cost. The total assets in ETFs have grown from a few $1 billion in the early 1990s to tens of trillions today. And the compression of management fees that competition among ETF providers has produced has been one of the most significant improvements in the financial conditions available to ordinary investors in the history of retail finance. The final phase of equity democratization has been driven by the Internet and mobile technology, which have eliminated many of the practical barriers to investing that previously restricted equity ownership to those with enough assets to justify the attention of a traditional broker. The emergence of online brokers in the 1990s, which reduced trading commissions from the fixed rates that had prevailed under the NYSE's commission schedule to a few dollars per trade, made it economically feasible for investors with small accounts to trade individual stocks for the first time. The subsequent elimination of trading commissions by major brokers in 2019, following Robinhood's introduction of commission-free trading, extended this accessibility to its logical endpoint. The frictional costs of buying and selling individual stocks are now effectively zero for retail investors. The consequences of this accessibility revolution have been mixed. The elimination of trading commissions has made it easier for ordinary investors to implement low-cost index strategies, which is straightforwardly positive. It has also made it easier for those investors to engage in the frequent trading and speculative activity that behavioral research consistently shows is detrimental to their investment outcomes. Which is more concerning? The GameStop episode of January 2021, in which individual investors, coordinating through internet forums, drove the share price of a struggling video game retailer to extraordinary heights and inflicted significant losses on the short sellers, who had bet against it, illustrated both the potential power of coordinated individual investor activity and the enormous risk that speculation disconnected from fundamental value analysis poses to those who engage in it without understanding the dynamics of the market they are participating in. Understanding the history of the stock market's democratization helps explain both why equity investing is more accessible and more important for ordinary investors than it has ever been, and why the behavioral challenges of successful long-term investing are also more acute than they have ever been. The barriers that once prevented ordinary investors from participating in the equity market also, incidentally, protected them from the temptation to trade too frequently, to chase recent performance, and to make the behavioral errors that are most damaging to long-term investment outcomes. Removing those barriers has been, on balance, a positive development, but it has also exposed millions of new investors to the full emotional intensity of market volatility and the full range of behavioral traps that 4 centuries of stock market history have revealed. The synthesis of everything the stock market's history teaches for the individual investor can be expressed simply, though the simplicity belies the depth of the evidence behind it. Own a diversified portfolio of equities through low-cost index funds. Contribute regularly, regardless of market conditions. Maintain your allocation through downturns without selling. Keep costs minimal. Be patient. These 5 principles, consistently applied over a long enough period, have produced superior investment outcomes in every market environment that history has yet produced. For every investor who has managed to follow them, the difficulty is not in understanding them. It is in following them through the periods of market stress and speculative enthusiasm that make them feel wrong in the moment, even when they are right over the long run. The history you carry now of the Dutch East India Company and the South Sea Bubble and the crash of 1929 and the dot-com boom and the financial crisis of 2008 and the pandemic decline of 2020 is the evidence base for those principles. Every major crash in that history was followed by a recovery. Every bubble was followed by a return to something closer to fundamental value. Every period of panic was followed by a period in which the investors who held through the worst moments were rewarded for their patience. The pattern is not guaranteed to continue. No pattern in financial markets is guaranteed to continue, but it has continued through every disruption that the past 4 centuries have produced. And that record is the foundation for the confidence that patient, disciplined, low-cost equity investing is the best strategy available to most individuals for building long-term wealth. You are lying there now. The market is closed, and tomorrow it will open again. Somewhere in the system, the algorithms are preparing for the morning's trading, processing the news that has accumulated since the close, modeling the likely reactions of other participants to each development, calculating the optimal opening positions for the strategies they have been designed to implement. And millions of individual investors are, like you, somewhere between sleep and waking, carrying somewhere in their awareness the number that represents their stake in the enterprise, rising and falling with the market's daily judgment about the uncertain future. What you carry, resting here, is something more than that number. It is the understanding of what the number is and where it came from and how it moves and what the long arc of its movement means for your own financial future. That understanding will not make you immune to the fear that accompanies a major market decline, but it will give you a framework for recognizing what is happening and for holding to the decisions that the evidence supports, rather than abandoning them in the moment when the emotional pressure is greatest. And here, in the quiet, the market rests. The bell is still. The algorithms are waiting. The future is uncertain. And all of that is, tonight, exactly as it should be. There is one more dimension of the stock market worth examining before we arrive at the final synthesis, and it concerns the global dimension of equity markets. The way that the American stock market, which has dominated our narrative so far, exists within a global ecosystem of equity markets that collectively represent the ownership claims of investors across the entire world economy. The American stock market is the largest in the world by market capitalization, representing roughly 40 to 50% of global equity market value, depending on the period and the measure used. But it is far from the only significant equity market. The London Stock Exchange, the Tokyo Stock Exchange, the Shanghai and Shenzhen markets in China, the exchanges in Hong Kong, Germany, France, Canada, Australia, and dozens of other countries collectively represent the other half or more of global equity value and offer exposure to the economic dynamics of economies with very different growth trajectories, institutional environments, and risk profiles from the American market. The globalization of investment has been one of the most significant developments in financial markets over the past 3 decades, as improvements in information technology, the reduction of cross-border capital controls in many countries, and the development of international investment vehicles, including global mutual funds and internationally oriented ETFs, have made it progressively easier for investors in any country to own shares in companies. Anywhere in the world, an American investor today can own a diversified portfolio of companies from dozens of countries with the same ease with which they can own a domestic S&P 500 index fund. And a growing body of evidence suggests that international diversification, owning shares in companies from multiple countries rather than concentrating entirely in one's home market, has historically produced superior risk-adjusted returns compared to home country-only portfolios. The case for international diversification is not primarily that foreign markets will outperform the American market, which is an unpredictable and historically inconsistent outcome. It is that different equity markets are imperfectly correlated, meaning that they do not always move up and down at the same time and to the same degree, so that a globally diversified portfolio is less volatile than a single country portfolio for the same expected return. When the American market is going through a difficult period, emerging market or European equities may be performing well, and vice versa, so that the global investor experiences a smoother ride than the investor concentrated in a single national market. The growth of Chinese equity markets is one of the most significant developments in global finance of the past 2 decades, and it raises questions about the future structure of global capital markets that will be important for investors over the coming decades. China's domestic equity markets, the Shanghai and Shenzhen exchanges, are among the largest in the world by market capitalization and are home to companies that are increasingly global in their competitive significance. But the regulatory environment governing Chinese markets, including restrictions on foreign ownership, variable interest entity structures that give foreign investors economic exposure to companies without full ownership rights, and the political and regulatory risks that the Chinese government's interventions in specific sectors have illustrated, creates risks for foreign investors that are difficult to fully assess and that have no direct parallel in the more transparent regulatory environments of developed market economies. The ongoing debate about how much exposure international investors should have to Chinese equities and through what vehicles is one of the most consequential investment debates of the present moment, and it illustrates a broader point about the stock market that is worth making explicit. Investing in equities is always, to some degree, investing in a specific political and legal environment. And the quality of that environment matters as much as the economic fundamentals of the companies within it. A company generating excellent returns in a country with poor property rights enforcement, opaque regulatory processes, and political risks that could expropriate or impair its value is not the same investment as a similarly performing company in a stable legal and regulatory environment. The country and the legal system are part of what you are buying when you buy equity, and assessing them is part of the investment decision, even if it is a harder and more uncertain assessment than the financial analysis of the company itself. There is a specific aspect of global equity markets that deserves particular attention for its implications for the average investor, and it is the question of currency risk. When an American investor buys shares in a Japanese company, for example, the investment is exposed not only to the operating performance of the company and the trajectory of the Japanese equity market, but also to the movement of the yen relative to the dollar. If the yen strengthens against the dollar while the investor holds the Japanese shares, the dollar equivalent value of the investment increases by more than the yen equivalent performance of the company would suggest. If the yen weakens, the reverse is true. Even strong company performance can be partially or fully offset by currency depreciation. Currency risk is a significant component of the risk profile of international investments, and investors who are not aware of it can be surprised by the return differences between the local currency and dollar equivalent returns of the same investment. For most individual investors, the practical implication of this complexity is to use a broadly diversified international index fund rather than concentrating in specific countries or attempting to actively manage currency exposure, which requires expertise and resources that most individual investors do not have. A globally diversified equity portfolio, combining American and international exposure in proportions that reflect their respective shares of global market capitalization, provides both the diversification benefits of international investment and a reasonable approach to the currency exposure that comes with it, without requiring the investor to make specific judgments about individual countries or currencies. There is also an important story to be told about the relationship between equity markets and economic development in emerging economies, because this relationship is at the heart of one of the most important investment themes of the 21st century. The equity markets of emerging economies, which include not only China, but India, Brazil, Indonesia, Mexico, South Africa, and dozens of other countries at various stages of economic development, offer exposure to growth trajectories that may be significantly faster than those of the mature developed market economies in which most Western investors have traditionally concentrated. The economic logic of investing in emerging markets is compelling in principle. If a country is growing at 7 or 8% per year, rather than 2 or 3%, the companies operating within it may generate earnings growth rates that translate into superior equity returns. And the process of economic catch-up that takes a developing economy from low income to middle income to high income is one that has historically generated strong equity returns in the markets where it has occurred. Japan's extraordinary equity market performance from the 1950s through the 1980s. South Korea's strong equity market performance from the 1970s through the early 2000s, and Taiwan's similar experience reflect the equity returns that can accompany rapid economic development in the right institutional environment. But the relationship between economic growth and equity market returns is more complex than the simple logic suggests. Countries that grow rapidly do not always generate superior equity returns for foreign investors, for several reasons. High growth may already be reflected in elevated valuations, so that investors are paying for the growth rather than earning it as a return. Rapid growth may be accompanied by the issuance of new equity that dilutes existing shareholders, reducing the per-share earnings growth even as aggregate earnings grow rapidly. Political and regulatory risks may be higher in rapidly growing economies, producing the occasional catastrophic loss that offsets years of strong performance. And the currency dynamics of rapid growth economies are complex and can move against foreign investors even when the local economy is performing well. The practical conclusion for most individual investors is, again, to participate in emerging market growth through a broadly diversified index fund rather than through concentrated bets on specific countries or sectors, accepting whatever returns the broad emerging market asset class delivers in exchange for the diversification and cost advantages that a simple index approach provides. The evidence that any particular investor can reliably identify which emerging markets will outperform and invest accordingly, after costs and currency effects and all the other complications of international investing, is weak, and the evidence that a broadly diversified emerging market allocation has historically enhanced the risk-adjusted returns of a globally diversified portfolio, while mixed in some periods, is reasonably supportive over long periods. The stock market, in its global totality, is something genuinely remarkable, a system in which the ownership claims of hundreds of millions of investors around the world are continuously priced, traded, and transmitted in real time, reflecting the collective assessment of the present value of the productive capacity of companies employing hundreds of millions of workers and generating trillions of dollars of economic value. The mechanism is imperfect, susceptible to the behavioral dynamics and speculative excesses that have characterized it since the first share of the Dutch East India Company was traded in Amsterdam 400 years ago. But it is also the most powerful capital allocation mechanism that human institutions have yet developed, and the returns it has delivered to patient, diversified investors over long periods represent a genuine economic achievement. You understand that mechanism now, in its historical depth and its practical implications, in a way that most people who participate in it never do. What you carry, resting here, is not a trading strategy or a prediction about tomorrow's market. It is a framework, a way of seeing the market as what it actually is, rather than what the daily news and the financial entertainment industry suggest it is. And that framework, maintained through the volatility that lies ahead, is worth more than any specific investment call. Here, in the quiet, the market rests. And so do you. But there is one final thread worth following before we let this rest completely. And it concerns the question that most people who encounter the stock market for the first time find most pressing. How do you actually make good decisions within it? Not theoretical decisions, but the practical choices that determine whether a specific individual, with specific circumstances and specific goals and specific psychological tendencies, participates in the equity market in ways that serve their genuine interests. The question is both simpler and harder than most of the financial media coverage of investing suggests. It is simpler because the basic principles of successful long-term investing are well established and widely documented. Diversify, minimize costs, invest regularly, and be patient. It is harder because following those principles requires overcoming behavioral tendencies that are deeply embedded in human psychology and that are actively exploited by much of the financial services industry. and much of the financial media. Let us be specific about the behavioral challenges, because naming them clearly is the first step toward managing them. The most destructive behavior for long-term investors is panic selling, the decision to convert equity holdings to cash when prices are falling rapidly and the economic news is frightening. This behavior is understandable, even rational seeming in the moment. Prices are falling, the future looks uncertain, and selling stops further losses. But it is systematically destructive for two reasons. First, it converts paper losses into real losses, making permanent a decline that would otherwise be temporary. Second, it removes the investor from the market at exactly the moment when the expected future return is highest, since declining prices mean that the same earnings stream can be purchased more cheaply. The investors who sold during the worst moments of the 2008 crash, the 2020 pandemic decline, and every other major market downturn in history, locked in their losses and then typically missed a substantial portion of the recovery that followed. The second most destructive behavior is performance chasing, the tendency to move money toward investments that have recently performed well and away from investments that have recently performed poorly. This behavior is driven by the availability heuristic, the tendency to judge future outcomes by recent experience, and by the representativeness heuristic, the tendency to assume that current trends will continue. It produces the same outcome consistently across market cycles. Investors end up buying high after the recent outperformers have already captured most of their gains, and selling low after the recent underperformers have already suffered their worst losses, and then waiting in cash or in recently outperforming but now overvalued assets when the subsequent recovery occurs. The third behavioral challenge is overconfidence, the tendency to believe that one's own analysis and judgment is better than the collective assessment reflected in market prices. This overconfidence leads investors to hold concentrated positions in specific stocks they believe are undervalued, to make market timing calls based on their assessment of where prices are heading, and to trade more actively than is optimal, incurring costs and taxes that erode returns without producing the superior performance that justifies them. The evidence that individual investors, as a group, significantly underperform the indices that measure market returns primarily through the combination of excessive trading and poor timing is robust and consistent across different time periods and different markets. Understanding these behavioral challenges does not make you immune to them. The emotional experience of a major market decline is genuinely frightening, and the rational knowledge that markets have always recovered before does not fully counteract the visceral fear that the current decline might be the one that does not recover. The appeal of a recently strong performer is genuinely compelling, and the rational knowledge that past performance does not predict future returns does not fully counteract the intuition that the recent pattern will continue, and the confidence that your own analysis has identified something the market has missed is genuinely appealing. And the rational knowledge that most investors who share this confidence are wrong does not fully counteract the human tendency to believe that you are one of the exceptions. What does help is structure, the prior commitment to a set of investment rules that are implemented automatically without requiring an active decision at the moments when the emotional pressure is greatest. Automatic contributions, which continue regardless of market conditions, remove the need to decide to invest during downturns, target date funds, or predetermined allocation rules, which specify how much of the portfolio should be in equities at different ages and different market conditions, remove the need to decide how to allocate during periods of extreme market stress. Infrequent portfolio review, perhaps annually rather than daily or weekly, reduces the exposure to the emotional stimuli that trigger behavioral errors, and a written investment policy statement specifying your objectives, your strategy, and the conditions under which you will deviate from it, which should be almost none, gives you something to refer to when the emotional pressure to do something different is most intense. None of these structural approaches require sophisticated financial knowledge or access to expensive financial advice. They are available to any investor through the standard financial infrastructure of most developed economies: employer-sponsored retirement plans, low-cost index funds, and the basic administrative choices about automatic contribution levels and fund allocations that most plan administrators make available. The sophistication required is not financial sophistication, but behavioral sophistication, the understanding of your own psychological tendencies, and the commitment to build structures that protect you from acting on them in ways that harm your long-term interests. The financial advice industry has, for most of its history, been poorly aligned with the interests of ordinary investors on these questions. Active fund managers who earn higher fees by making active investment decisions and who therefore have a financial incentive to convince investors that active management adds value, have dominated the investment advisory landscape and have consistently steered investors away from the passive index investing that the evidence supports and toward the active strategies that justify their fees. The gradual shift toward fee-only advice, in which financial advisors are compensated through flat fees or percentage of assets fees rather than through commissions on the products they sell, has improved the alignment somewhat, but the industry's incentive structure continues to push in directions that are often contrary to the interests of the clients it purports to serve. Understanding this misalignment is part of being equipped to navigate the financial services industry effectively. The financial advisor who recommends actively managed funds over index funds is not necessarily dishonest, but they may be operating within an incentive structure that makes active management recommendations financially advantageous for them, regardless of whether they are best for the client. The financial media that covers market movements every day and generates constant commentary about what investors should do in response to the latest news is not producing content designed to help long-term investors make better decisions. It is producing content designed to attract and retain the audience that advertising revenue requires, which means content that is emotionally engaging and timely, rather than content that reflects the patient, boring, infrequent activity that actually produces good, long-term investment outcomes. Being a successful long-term investor in the stock market is, in the end, mostly about not doing things, not selling when prices fall, not chasing recent performance, not trading too frequently, not paying high fees for active management that underperforms passive alternatives, not concentrating your portfolio in specific stocks or sectors, and not deviating from your strategy in response to the constant flow of financial news and commentary that suggests you should be doing something different. The positive actions, choosing an appropriate allocation, contributing regularly, rebalancing periodically, minimizing costs, are important, but they take very little time and effort once the initial decisions have been made. The negative actions, the things you choose not to do, are what separate successful from unsuccessful long-term investors, and they require ongoing behavioral discipline that the full history of market crashes and speculative manias makes it much easier to maintain. You are lying there now with everything the history has given you tonight. The 4 centuries of Dutch trading companies and American railroads and industrial conglomerates and technology platforms that constitute the stock market's accumulated achievement, the crashes and panics and regulatory responses, that constitute its accumulated painful education. The behavioral research that explains why individual investors so consistently underperform the simple strategies that the history supports. And the practical synthesis that distills all of that into something actionable. Diversify, minimize costs, invest regularly, be patient, and resist the behavioral pressures that the market's volatility will constantly generate. The number in your retirement account will change tomorrow. It will be different next month and next year in ways you cannot predict and that do not particularly matter for the investment decision you are now equipped to maintain, regardless of how they move. What matters is the long arc, the decades-long compounding of regular investment in a diversified, low-cost portfolio that participates in the productive capacity of the modern global economy. That arc has been upward across every period in the history of the broad equity market, and the framework you now carry gives you the context to maintain your participation in it through whatever the next crisis brings. Here, in the dark, the market rests. As it rests every night between sessions, the bell will ring in the morning, and you will be ready, not because you know what the market will do, but because you understand what you should do, regardless of what the market does. And that, resting here in the quiet, is exactly enough. The history is long. The evidence is clear. The principles are simple. And the patience required to follow them is the one thing that no financial product, no advisor, and no algorithm can provide for you. It has to come from understanding, from the kind of deep familiarity with the history that makes the temporary nature of every decline feel real rather than merely theoretical. That understanding is what tonight has been building toward. And here, in the dark, after 400 years of Dutch sea captains and American railroad barons and technology entrepreneurs and every investor who has ever held a share through a market that scared them and been rewarded for it, that understanding rests with you. The market will open tomorrow, and you will be ready, not because you have a prediction, not because you have an edge, but because you have a framework and a history and the understanding that turns 4 centuries of market data into something you can actually use. That is more than most. And here, in the quiet of the night, it is enough to rest on. The bell is still. The algorithms are waiting. 400 years of financial history are resting alongside you in the dark. And the number in your account will be whatever it will be. Tonight, none of that matters. Tonight, you understand it. And understanding it, you can let it go. The market will be there in the morning, and so will the patience and the framework and the long view that makes patience possible. All of it waiting, quietly, for whatever tomorrow brings.